Hi, my name is Bex Swawidu, and I'm here with Nzobe Ofodeke to talk about financing frameworks for business.
Yes, and we'll be talking about how to access investors and lenders. Thank you for joining us.
Who we are. My background is working at CBO Investment Management, raising capital for African businesses. Before that, obviously, I trained in the UK, the London Business School, Cambridge University, done a lot of things in terms of financing Africa, raising over $300 million for African companies and SMEs.
And in my 20-year career, I've done quite a few things. I currently am an entrepreneur in residence for a large corporate venture where I support companies with their investment strategy and fundraising. Studied at Queen Mary University of London, also at the University of Nigeria Enugu campus, worked in quite a few financial firms from Henderson to UBS and PIMCO, and I love to vote.
This slide is about your money need. So I'm going to let Nzube talk to you about that.
Sure. Yes. Thanks for that, Beck. So here, we want to break it down as to why you need or why you want to raise capital in the first instance. As a business, cash flow is critical to sustain your company. It's the lifeblood of your business, as any business owner would know. However, when going out to raise capital, you can't just say, I need money and give it to me, please. You need to be a bit more structured. So you break down what you need the money to do. It's clear, it's obvious. You need to be as granular with the outlay of what you forecast the spend would be on. You also need to, in that process, determine how much exactly you need to raise. That's a critical part of that fundraising process. And if it's going to be equity, you need to also have a clear idea of what valuation you need, or what type of equity slice you're going to give away to a potential investor. Thinking about what terms and conditions come with a particular loan instrument is important. Looking at what protections you might be able to provide, what guarantees or which other sources of capital to go to if the primary sources of capital are not available to you is pretty important. So thinking through the money need starts with doing analysis inwards, breaking it down in a very structured way before going out to approach investors. We'll go into the process in a bit more detail later on, but here we're just trying to figure out the why and the what from your money needs.
Thanks, Zoe. That's very accurate. And so we can go to the next slide now. And your money journey, funding theory versus funding reality.
Exactly. So on this slide, here we're going through it in a bit more structure, how one raises capital. If you are more of the structured project management type, you can recognize this is a waterfall process on the left-hand side, where we start from investor mapping, go to investment readiness, pitching to investors, due diligence, and the actual drawdown when we get the investment. Each of these phases has items that one has to deliver in order to move to the next phase. So with investor mapping, what we're looking at here is making sure we have a global list, a universe of all the potential investment partners we want to reach out to for our particular business. The terms of their types of investments, where they're located, what process they go through when looking to engage a new entity. Looking at what those investors bring to the table apart from cash. Many companies in the early stages of development need more than money. Sometimes it's called smart money. There is no such thing as dumb money, in my opinion, but it refers to having that greater value add where the investor is doing things like expanding business development, introductions to other potential partners, be they financial or otherwise, helping with recruitment and other facets of your business that you need more than money to solve. Once you have that investor mapping done with your long list, you can filter down to that short list of investors that you want to spend time approaching. That's the work. You move on to investment readiness. This is following on from the last slide, the items within your company that need to be well articulated. You need to present your summary, your executive summary, your pitch deck, what the team strengths are, any competitive advantages, what your current traction is. So in terms of your commercial successes and wins, all these things add to giving the investor or the lender the perception of de-risking of your business, that you have done a little bit more than just write out an idea on a napkin, and you have something to show for the things that you say in your business can and will do. Once you have all the materials internally, all those documents, then you can start pitching to investors. You start nowadays, obviously virtually, but most investors would prefer to meet their potential investee companies or lendees before they put capital into the company. With the virtual world, it's easy. You send an email, you reach out via LinkedIn, you give a very brief summary. No one's going to want to read a 2, 3, 4-page document at a first go once they see your first message. So start with a very pithy summary, what it is you do, your elevator pitch, and why you want to engage with them. You go through the process. After getting that first interest, you take them through that funnel. It's similar to a business development sales funnel. You need to have a spreadsheet that you manage those relationships as you push them along the funnel of interest. When they get back to you wanting to know more, you can share more, an executive summary. After conversations, you can move on to a pitch that you have in person. After the presentations, you can go to the next step, which is the due diligence, if there's still interest. In the due diligence phase, you have a data room where all the material and an investor, a qualified investor that you've been speaking with, and you do feel comfortable assuming that they would participate in your round, they go into that data room and make sure there are no skeletons in the cupboard. They'll need to verify everything you've told them so far, looking at your investment memo, looking at financials. Then you start to work on term sheets and you start to negotiate the term sheets. So there are various aspects of a term sheet to look out for, things like participation rights, liquidation preferences. You definitely need a lawyer if it's your first time raising capital from a venture capital fund, or even if it's your first time taking a loan from a financial institution, you need to make sure that you have the right clauses that protect your business. And the next step after the due diligence and negotiation is the drawdown and the actual liquidity event. So this timeline can be anything from, a couple of weeks to several months. It's rare for it to happen instantly. Well, it's very unlikely to happen instantly. So you need to plan several weeks to several months when looking to raise capital. On the right-hand side, we have a sort of Brownian motion style approach to fundraising where there's a bit of randomness, which is, I'll say the reality is slightly somewhere in between both. You don't have the very structured agile method. It's more, you don't have the structured waterfall method. It's more agile where, you might have to go back and forth from investor mapping. When you get to pitching, you might need to go back to investor mapping, etc. You want to align your due diligence so that when you're getting offers and term sheets, they come all at the same time, but the rest of the process can be pretty iterative. It's long, it's arduous. It's better to get advisors that can support you through it. And yeah, this is a quick summary of that fundraising journey. Over to you, Bex.
Thank you very much. Exactly. I mean, it's almost like a marathon starting line where everybody may start at the same time, but things get chaotic pretty quickly. And hopefully you've got everybody going in the same direction, but they might get to the various stages at different points. So it's very, very important that you stay focused and you can actually get through what is a long and layered process. Moving on to the next slide, we look at the different types of money providers, and that's really important. The headline here says, money, money everywhere, but no bank alert for me. Now, there are literally hundreds of different types of organizations, institutions, or sources of capital for your business. And on the table on the left here, it shows you grants, central bank or other concessionary funds, impact funds and foundations, equity investors of two types. I mean, you've got angel investors, venture capital investors, and private equity investors. And then you have the DFIs, and then you get into debt and banks. And you can actually get debt from bank funds as well. Now, the additional challenge for African businesses is that quite a lot of these funds they can be local in Africa, but they can also be located overseas, and they're in numerous countries. They deliver different amounts of capital. There are different complexities to their needs, and also in terms of their headcount and their access and their relationships. So there is money everywhere, but you've actually got to really understand the kind of money that you really need and that will help your business. And that's why we go back to that first slide where we ask you, what do you need the money for and why do you need it? And then we have this is what we call the money toolkit. To raise funding from each of these different types of funding, they have different requirements. Now, in order to go on into the project, you need to have certain items or resources to hand. So you might need a grant application for one and maybe a little deck for another. For DFI, you might need an application, a deck, a financial model, and a business plan. For an impact investor, they might be quite interested in your ESG your environmental and impact outcomes for your business. For venture capital, they're looking at returns and they're trying to see what networks you plug into, what intellectual property you're developing, where it fits into their portfolio. And for bank debt, they're very often just worried about losing their money. And so they're very much concerned about collateral, alignment and contributions. When you have things like that, you realize that the document sets can be different depending on the type of money you're chasing. Now, if you start chasing multiple types of money and you've got multiple entities within those types of money, then the document sets can get very complicated indeed. And that's the blue sort of rectangle in the diagram. It shows that just with 4 different types of documents, with 2 capital sources and 10 targets, you're up to 80 different types of documents flying around that you're trying to keep up to date. So our rules in terms of the financing process are fourfold. A, keep it simple. The second thing is to invest in flexibility in terms of your document sets and in terms of your financial modeling. Invest in a proper document management and maintenance and tracking solution. So even if it's just a Google Drive, just make sure that you have somebody who's on top of it and that your documents are well categorized and logged. And then also invest in tangibility. These days, a lot of the investors actually want to see a business and they want to feel a business. It's not just reading something on a page. They want to see video, they want to see personal interviews, and you can save time by recording that and using more rich media online and on file to actually sell and tell your story. So just tip 1 and tip 2 here, we talk about the variations and customizations can really add complexity. So just bear that in mind. And in terms of delivering this actual process, try and appoint someone within the organization or an advisor who's either done this before or who can be focused on this process. As you can see, attending to 80 documents or 40 documents can be a highly complex task and an engaging task. So they have to be focused on doing that. Zubair, anything to add?
Absolutely. Sorry, I was just unmuting myself. I think absolutely thinking about all those aspects are critical. One particular item I like on this slide is, and I say, if I can paraphrase the legendary Bianca Del Rio, not today, Satan, it's more around not all money is good money. It's worth remembering that when you're looking for a particular type of investor, you need to be aligned. They're going to be your financial partner for the medium to long term. So making sure that there's that alignment during that process of engagement is important. And everything Bex has said, I echo and agree, just making sure that managing that process is as streamlined as possible. Otherwise, you'll spend much more time than necessary chasing capital and insufficient time actually running your business.
And that feeds into the deal value versus time value point, okay? Because the key thing is if you spend so much time chasing capital when you're actually losing the IRR of the business, the actual growth. So a couple of points on the cost of capital versus a couple of months or quarters on time of growth is a trade-off that you've got to think about. The next point we look at here is DIY versus advisors. Now, it's great to do it yourself. The first time you're raising money, some people will see it as glamorous or fun. But if you've done this many times, it does get quite dull. And you've got to sell these stories with energy and with passion to tens, if not hundreds of investors. It can take a lot of time and take a huge amount of time away from actually growing the business and selling the business. You can't actually run away from selling the business yourself. I mean, fundamentally, investors are investing in the principles of the business, those people who are leading and driving the idea. So they have to be there, but it's just the way in which the process is run and the way in which it's managed can be structured slightly differently. The next point I would like to make is that it's a big world. The table in the previous slide showed that there are different types of advisors. They're based all over the world. They've got different sectors covered and different types of funding. So there are lots and lots of investors. We ourselves have over 800 on our database for any particular type. If you're looking at, say, renewables or tech investors, there are subsets of these investors, but there are lots of them. The key thing is that with that big world can come a lot of time and a lot of expenses trying to reach these investors. And so organizing yourself and structuring yourself is very, very important. Zubir, I think you want to talk about the fact it can also be a very small world.
Indeed, because whilst you might be fundraising and think you're speaking with disparate investors, most investors do speak to each other. They swap notes, they're in similar WhatsApp groups, LinkedIn groups, attended the same business schools. So the network of investment community, or the network of the investment community, is pretty small. So you need to make sure that what you share, the documents you create, are consistent. You can't tell one person one valuation and tell another person a different valuation, because it'll come back to make you look inconsistent. And just managing those relationships, because it's down to those individual relationships at the end of the day. Even if an investor does not advance to taking up any interest in your company, but if you've left a good impression and you've been professional, then they would be happy to signpost you to other potential investors where there's greater alignment. So think about the long game and not just the transactional instant meeting.
Exactly. And that's it. I mean, the last point here, I think, is the fact that it is a cycle. I mean, you can see that we go from birth to death very quickly. And that is really investment all the way through to exit. And that's what the investor is trying to understand about your business. So when they make their inquiries, when they do their due diligence, there's going to be a lot of repetition. There's going to be a lot of probing, a lot of testing. They want to understand the relationships in your team to see if you can survive not only the good times, but also tough times if they do come. And they want to understand how you're going to act during those difficult times or when challenged about the business. Not all money is good money. I think Zubir's covered that point. Many businesses need cash, but they also need guidance. They need access to customers. They need but develop supply chains and logistics, etc. So we know all that. So at that point, we want to say, thank you, very much. We wish you the best on your funding journey. So I'm going to say goodbye from me, Bex at Money Ready, and
goodbye from me, Unzube. Thank you for your attention. Have a good day.
Thank you.